Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 2, episode 40, and it's part 5 of the lease options module that we've been on. And honestly, I'm super excited about today's session simply because to me, this is really the core of how to get into an investor's mindset and operations and how we really assess the viability of any market or any strategy in this particular case that we have chosen to want to focus on. And so I just want to really bring this up before we get started is the fact that in any type of investment opportunities, there are always two things that we look for, especially when it comes to leveraging real estate as a vehicle. The first thing is cash flow. Cash flow is definitely king. The reason why we focus on that once again is because when you have cash flow, that means you have a viable business. Okay. The funny thing about real estate, once again, is that so many people, just because they think it's properties, so they're always waiting for the long-term gain and forgetting about the fact that, you know what, at the end of the day, if you want to be a sustainable business, you want to build a viable portfolio and you want to build a healthy long-term wealth, it still starts with cash flow. And honestly, we're looking for big cash flows here. However, at the same time, the idea is as long as you're in the positive every single month, you're going to be just okay. All right. So the idea behind all of this is that I've just seen way too many people now at this point. They just think that, okay, you know what? It is totally fine if I don't make any sort of cash flow on a monthly basis because I'm waiting for the big cash out day, 10 years, 20 years, 30 years from now. And you're putting yourself in so much danger that way. We're going to be talking about how to really determine whether or not a market is in a bubble and what it really means when people are saying that the market's in a bubble. And I've seen also so many trainings out there these days now that are talking about the fact that COVID or the pandemic has fundamentally shifted the real estate market. So I'm going to say yes, on some level, the markets are have been shifted. However, the markets are constantly shifting, COVID or no COVID, regardless. However, the fundamentals of what drives real estate as an investment vehicle does not change at all. These are age-old, century-old wisdoms and formulas that work. And that's simply because the fact that it is one of the oldest asset classes that we know. In fact, probably the oldest, because before our ancestors were able to create businesses and create stocks and sell shares, before mutual funds, before currencies were created, and before even they could dig up gold and precious metals, everybody still needed a roof over their head. And back then maybe a roof is a piece of giant leaf or a giant tree, I don't know, but the point is this is one of the, if not the oldest asset classes that we know. And this is why it's really funny to me that so many people are saying, oh, real estate has changed so much. Yes, the markets have changed. However, just remember that don't fall into catchphrases and people that are just really creating headlines to grab your attention. However, there's no substance behind it. And this is one thing that I love the most about real estate investing education is the fact that you get to really see through all the bullshit for yourself. And that's what we're here for, okay? So once again, coming back here though, what we focus on is the cash flow side of things. And in the beginning, you definitely want to build up your cash flow simply because of the fact that when you have your cash flow and you can get yourself to the point where you're financially free, meaning that you have enough passive income to cover all your basic expenses so that you can free up your time to pursue other opportunities, other investment deals, other maybe passion projects. And so most people, they tend to think that, oh, all you're preaching about is cash flow. At what point can you just start to buy properties or invest in properties that you actually want to invest in? And I'm saying basically I want to make sure that that message is loud and clear. My personal take is that once you're financially free, you're free to do anything you want to do. And this is why I just want to make sure that everybody sees building in a passive income, more importantly, having financial freedom as that blanket, as that safety net for you so that you can go out and if you want to, take bigger chances, take bigger risks and gamble a little bit, that's when you can start doing that so that if the projects do not go as planned, all your bases are still covered. Okay. And so this is why we continue to focus on cash flow. And the second most important factor is return on investment, because once again, that tells you how hard your money is working for you. And ideally, we all want our money to be working hard for us because we understand the concept of us as human beings working hard. I think most of us were brought up with that same kind of work ethic, the same mindset. You have to work hard, and I'm not disputing that. However, what most of us are not doing is we're not learning to work smart, and we're not learning to work smart fast enough. And I'm just going to say this. I feel like, yes, I spent a lot of my years in my 20s blaming my health conditions and blaming that life wasn't fair. Why did I get heart attacks? Why do I have autoimmune disorders? Why do I have to start walking with a cane by the time I was 25? And then over the last few years, though, what I've really realized is that all those things that happened to me became true blessings. Because when the first time I heard the phrase, time is everything, I grabbed onto it and I never let it go, because having gone through those times when I really felt like I was very fragile and that you never know what life is going to throw at you and when you're going to leave this planet. And so time truly is everything. And this is why, again, return on investment, it is so, so, so important. We're going to go into the rule of 72 next week as well, so that we can understand why it is so vital for us to make sure that we learn how to work smarter so that the money can keep working harder and harder for us. Because again, one of my favorite people to learn from and follow is Warren Buffett. And he says that if you're not learning to make money while you sleep, you're going to be working till the end of your life. And that is so true right now. And so learning about how you can make your money work for you and work harder and harder, because guess what? Money has the ability to continue to work harder 24/7 for years, for decades, for centuries. Whereas as we get older, we have more problems and it's a little bit more challenging for us to give it our 110% at all times, whether or not we like it. And this is why I think a lot of you have heard a little bit about my joke, is the fact that buildings are like people. The older we get, the more problems we have and the more it costs to maintain. And that is so true. And when I say cost, I don't mean just money. It takes time and energy and money to maintain buildings and our physical wellness so that we can keep going. But this is why looking at the factors of what can make your investments and investment portfolios grow in the long term are so, so, so important. Okay, so today, what I'm going to do is I'm going to leverage the exact same strategy that we've been on, which is lease options, to demonstrate this concept first and foremost. So what I'm going to do now is share my screen with you guys. You know what? This is the one thing that I really love about doing it in this format, because there seems to be a bit more flexibility, and I can share screens with you and leverage different tools with you. So today, let's forget about the price of the market, the value of the property for a little bit, because what I really want to share with you, like I said, are the factors that could influence the level of cash flow and the return on investment you're getting from your money. Okay, so I'm going to walk you through a very simple spreadsheet right now. And this one, we're going to utilize a purchase price on a property of $318,000. So this sort of goes back to the Ontario deal example that I shared with everybody a few days ago here in the previous episode. And so accepted offer is 318. Let's just say that that is our final purchase price on that property. And assuming that we're required to put down 25% as our down payment, that means first mortgage loan to value is 75%. So that works out to be $238,500. If you want to double check, make sure that you turn on your mortgage app, whatever it is that you're using. Okay, remember, I'm using the Canadian mortgage app simply because the way our lenders calculate mortgage payments in Canada are a little different from our friends even just south of the border as well. So at $318,000, when you type it in, make sure you double check if you got a 25% down payment, that's $79,500. You can see it here now in line 19. So everything's matching up, no problem. On a monthly payment side of things, I still have the 2.8% and 30-year amortization right here. And I think that was from the BC example that we did in the previous episode as well. However, let's not go that far yet. So let's figure out the initial investment. So if you see line 27, it says total initial investment. So let's backtrack now. First component within the total initial investment is 25% down payment, which is $79,500. And then line 20, legal fees of $2,000. And then appraisal, inspection, miscellaneous, we've been using 500. So I'm gonna just type that in there. And that's not the right cell, so let's go here. So 500, let's just add that in there. Ooh. Okay, here we go. Okay, so I think we can still see everything. And land transfer tax. You know what? Let's bring this deal back to Ontario because I understand that confused a few people. Remember, unless you're in a province or a state or a country where there is no stamp duty, land transfer tax, purchase tax, or property transfer tax, whatever your local government or your federal government calls it. Okay, so I'm just gonna keep that section in there so that we make sure that it covers more ground, because I know right now Alberta and Canada is still a bit of a unicorn where when you buy a property, there is no land transfer tax, whereas most other provinces and states and countries will have that, especially after you hit a certain threshold there. Okay, so if we go back to the Ontario market at 318, the land transfer tax here is 3,245, so $3,245. So let's put that in there. And we have an initial option consideration of $12,500. So total initial investment is $73,745. So as we keep moving forward, let's figure out sale and transfer. So at the end of the program right here, so let's just say that we are in a 5% market a market where there's 5% average annual appreciation. So what that really means at this point is that if you want to take the 318 as our purchase price once again, okay, so this is something that we've done over the last 3 episodes already. I'm just putting it back into a spreadsheet to show you. So 318,000, this is a 3-year lease option or 3-year rent to own. So I'm just going to bring it back down here, times 1.05 times 1.05 times 1.05. So we actually have 368,124. Let's just say 368,000. How's that? You can round it up if you want to. In this case, I'm just rounding it down by about $124 to get 368,000. And so we did say that the mortgage rate that we are using is 2.8% right now over 30 years. So what that means is at the end of the 3 years, there is a mortgage balance of 222,575. And that's something, once again, that I got from the mortgage calculator as well. And then legal costs at closing, $2,000. Initial investment, meaning we got to pay ourselves the initial money back that we had to put in to get into the deal. Okay, and then we have to rebate them the $12,500 plus the monthly option consideration. Okay, and so profit at closing is $33,600. So again, when you get to help a family or somebody achieve home ownership, and on that same day you get to pocket $33,600 in your bank account, is that a good day or a great day? I don't know about you, but to me, that's an awesome day, okay? you help somebody and make money at the same time. And this is why one of my favorite sayings from Sir Richard Branson, the CEO of Virgin Companies, he says, if you're not in business to provide value to others, you might as well not do it. And that's what I love about this strategy so much as well. And so moving forward, cash flow, cash flow, cash flow. Remember, this is still ultimately our first priority whenever we look at any sort of deals, any strategy, any market, any properties. So in this case, let's just say that the average fair market rent, I'm going to drop it down to about $1,750. How's that? So that means monthly payment that we're collecting from the tenant buyers in this case is $2,405. So in this case, this little cell has a very simple formula, which is, as you recall, the fair market rent plus the monthly option consideration. And in this case, we predetermined it as $655. And so let's take a look now. PI payment, which is our mortgage payment, is 977.93. So let's just do 978. I'm gonna round it up by 7 cents, 7 pennies, okay? And then property tax, I'm going to say it's about $260. Now, I wanna remind everybody that the property tax number that you put in here right now, I know, let's just say that if you have an annual tax bill of $3,000, the first instinct is to just put in $3,000 divided by 12, which works out to be $250. However, I just want to make sure that everybody understands that property taxes, even if your property values drop, rarely do your property taxes drop year after year, okay? So always overestimate that. So in this case, you can put 260 if that's the case, or 275 or 280, whatever number you want to put in to make you feel more comfortable, that you can sleep better at night in peace. Okay, just remember, overestimate your expenses. And in this case, insurance is the same way too. I have never ever, apples to apples, and you keep the same policies, in my entire life so far, even before I started investing in real estate, I have never witnessed any sort of insurance policies go down in premium prices. So if you have, let me know, okay? If you have, let me know. I would love to hear it, because maybe we got a portfolio switch coming up with another insurance provider. So same note for you is that you want to overestimate that. So if your quote right now works out to be about $100 a month, maybe add $10, $20 per month on top of that, just so that you get a good average there, okay? So at this point, you will see a monthly cash flow of $1,047. Let me ask you this: how many of these kind of deals do you need to achieve financial independence or financial freedom? I understand most Canadian households only need about $5,000 on average to reach financial freedom, meaning all their basic expenses are paid for. So if, God forbid, anything happens to any of the breadwinners and income earners in that house, all the bills are taken care of. Nobody needs to worry about how they're going to put food on the table or even keep the roof over their head, because they're not going to be missing any sort of mortgage payments. Okay, so $1,047 is what we have, and in this case, over 36 months, we are making a total of $37,692. So when you add this number up with the total profit from sale, let's go all the way up here on the right-hand side, we will see the highlight of the deal. So in this particular case, okay, it's a 3-year term. The total profit on this deal is $71,292, which works out to be about 32.22% return on investment on an annual basis. And in this case, the tenant buyers at the end of the program will have accumulated just a bit over $36,000, which translates into 9.8% of total option consideration that's going to get converted into their final down payment when they're qualified and choose to exercise their option to purchase. So in this case, if you remember, what we keep on saying is make sure that you get them to the 10% mark. However, at the same time, some of your tenant buyers might go, we're just not able to do that, because you got to remember that total option consideration money is accumulated as a total of the initial option consideration and their monthly option consideration. And this is where you would want to definitely check with your mortgage specialist who's going to be qualifying your tenant buyers and working with them and with you throughout the duration of the lease option program to make sure that even at below 10%, the success rate is still high. Again, at 9.8, based on what we know today in Canada, it still works really well simply because the government only requires 5% of down payment when somebody's buying their principal residence. So we're still at almost double that. However, if this particular tenant buyer is self-employed, then we already know 9.8% is not going to be enough. And the other side that I want to really caution everybody on is the fact that if you do apply the strategies in a place, in a market, in a country, in a city, in a province, in a state where there is land transfer tax or the like, you need to make sure that you might even have to go into the 12, 13% so that you can put some of those money that you're collecting on their behalf like a forced savings account so that it helps them with the closing costs later, meaning their legal fees, their land transfer tax, and any other miscellaneous fees that can potentially come up. Okay, so that is completely a business decision that you can make. So what I'm going to do here is that I'm going to take a picture of this now. And what I'm going to do is let's write this out. Okay, let's write this out quickly. So, whoops, not this one. So go back to my little whiteboard and we're gonna write this out, okay? So our base scenario is the fact that we have, when the purchase price is at 318K and the option to purchase was 368K, okay? Now, initial option consideration in this case, I forgot how much it was. Let's take a look once again. 12,500. 12,500. And then our cash flow on a monthly basis is this much. And then our ROI is this much, 32.22. That should not, that should not have a dollar sign there. So 32.22% per year. All right, here we go. So what we're going to do is just examine the first factor. I want to take the next few days to go over a few more as well. Today, I'm just going to show you one. So what we're going to do is the next scenario we're going to go into is changing IOC. Changing IOC. So same thing, purchase price is still 318K, option to purchase is 368K. So IOC, we're gonna change that. Instead of 12,500, we're going to increase that to, let's say they have $15,000 saved up towards the purchase of their new home. So let's do that. And after this, we are going to find out about their cash flow and return on investment. So let's go. It's kind of fun to be able to switch around here. So let's put it this way. If everything else is held constant, okay, just adjusting to make sure that the entire screen shows here. So we're still at 318 purchase price, nothing else changes, meaning our financing terms. So let's go down here. In total initial investment, down payment still 25%, same legal fee, same appraisal amount, same inspection, and then miscellaneous, we're still gonna put in 500 here. And here, instead of 12.5 now, we're gonna change that to 15,000. Okay, so line 26 here. Before it was 12,500, now we're doing 15,000. So moving forward, we will see a total initial investment of 68,000. Okay, so let's keep going. Sale and transfer. The option to purchase price, remember we were doing 5% market appreciation and it was $368,000 as the option to purchase. And we're at 2.8% over 30 years, I believe our mortgage balance was, let's just borrow it from the other sheet here, 222,575. So 222,575. Let's update that number here. And so legal cost at closing is still $2,000. Pay ourselves back $68,000. That's a great day too, when you get to recover your entire principal. And that's the thing about this. This is why we count the principal back first before we even calculate anything. Me included, I've had the experience of investing before, not knowing what I was doing, and ended up losing my principal, the money that I actually put in. So instead of making money, I actually lost money. So in this case, when that full amount is there, that means your capital is 100% preserved, okay? So moving forward, initial option consideration, 15 in, 15 out, we're rebating it back to them, and we're not even changing the monthly option consideration here. So total profit from sale of the property and transfer of the title to our tenant buyer is $36,845. So let's go down to the cash flow section here. We changed it to 1750. So 1750. So what that means is on a monthly basis, we're at 2405. That actually didn't change from the last scenario to this scenario. So we're just keeping everything pretty much exactly the same here. 978 is our mortgage, so our PI there. Property tax, we said 260 earlier, so let's put down 260 here as well. Insurance, we put down 120, so it's 120 here, which means our cash flow, funny enough, actually didn't change. However, let's bring it back to right here, back to highlights, 3-year lease options. So total profit, okay, total profit is now 74,537. I'm going to take a picture of this, and then ROI is 36.54%. Total option consideration is 38,580. That translates into a total option consideration of 10.48%. So yeah, everybody's happy here. However, let's go back to our little whiteboard here and do a quick summary of the scenario, okay? So cash flow, hey, didn't change. However, our ROI now is 36.54%. That means it has gone up. It has gone up. So remember, return on investment is calculated based on the total profit of the deal divided by the total initial investment in this particular case. So our total initial investment actually went down. Why? Because the IOC went up. And our total profit actually went up, and that's what causes the whole thing to have an increase here. So that is one of the first ways, and to me, this is one of the methods that is basically completely within our control. Nothing else changed except for the initial option consideration. And so this comes down to how you actually work with your tenant buyers to make them understand the benefits that they will also enjoy by increasing their initial option consideration as well. And this is why, you know, we also teach during the full lease option advanced classes and during raising funds for your business, we always dive into how you can actually work with the various parties within the investing business. So that includes not just your power team members, like your realtors, your mortgage brokers, accountants, lawyers, general contractors, property managers. It also includes your clients on the other end. And those are your typical tenants as well as your tenant buyers in this particular case. So this is the first factor that I wanted to share with you, which in my opinion, once again, is probably one of the easiest ones that we can have an impact on very, very directly to change, and in this case, increase the performance of your lease to own programs. So with that said, I hope you followed this one. This is one of my like the most exciting subjects for me. So I'm going to go into this a little bit more over the next few days as well, and hope you will enjoy the ride with me. Thank you so very much for watching this episode once again. I would love to hear your comments, your feedback, because for the latter part of season 2, I'm becoming more and more technical with all of you as well, because that is really the heart of how we assess the viability as well as the profitability and the sustainability of building a healthy long-term real estate portfolio is all about. So hope you enjoyed it. Thank you very much. Please share this video with anybody that you think can benefit from the knowledge and the content that I'm sharing with you. And I look forward to seeing you back here for the next episode. Enjoy the rest of your day, everybody. Live well.